The first step to profitable trading is to trade with the direction of the trend. The simple moving average is an indicator that identifies the direction of the trend. Welcome. In this session, we will learn the following. How simple moving average is calculated. The implications based on values and other mechanics. Trading strategies using the indicator. And practical trading tips using the concepts. When we look at a chart, we can visualize that the price doesn't go on a straight line but rather fluctuates as it moves through its primary trend. Moving average is used to indicate the direction of the trend. It works by smoothing out the random price movements out of the trend. One drawback of using moving average is that it lags since it averages the prices on its look-back period. This results to the most recent price movement not reflective on the moving average line, thereby lags in giving a signal when there is a major turning point in price. Moving average is calculated based on the closing prices. The average line is plotted based on the value on the look-back period. In this formula, A stands for the closing prices while N stands for the number of periods. The sum of the closing prices on the look-back periods is divided by the number of periods, thus the average. Let's use the given data to calculate the 3-day simple moving average. Each price corresponds to the day's closing prices. Here, we will get the average of days 1 to 3. We add the values and divide by 3 to get the average of 1.050. We then move to the average of days 2 to 4, thus the term moving average. Again, we add the values and divide to get the average of 1.073. We continue doing the same process starting to day 3. Then day 4, until we complete all the results. The resulting averages are then plotted on the chart using a solid line. The same process goes if the look-back period is 10, 20, 50 or whatever period the trader pleases to use. MA periods may be changed according to the trader's preference. Short period MAs are used for short-term trading. MAs 20 to 50 are used to identify secondary trends. MAs 50 to 200 or more are used to identify the primary trend. There are common setups using the simple moving average. 5, 8, 13 MAs are used by short-term swing traders and day traders. 20, 50 and 100 are used to identify secondary trends within a primary trend. MAs 50, 150 and 200 are used to identify the long-term trend. A skilled trader may utilize different MA sets and combinations of short and long periods to his strategy. When two MAs intersect, this is called a crossover. Crossovers are commonly used to indicate the presence of trend better than a single MA. There are two types of crossover. The first one is called the golden cross, when a short period MA crosses above the long period MA. This may signal an uptrend, especially when the price is above the two MAs. The other type is called the death cross, when the longer period MA crosses above the short-term period. This may signal a change in momentum, or a downtrend, especially when the price is below the two MAs. Crossovers may signal the beginning of the trend, the change in trend direction or change in momentum, depending on which part of the price cycle they appear. Carefully take note of the implication provided here. Let's dissect what happened to the crossovers in the chart. Number 1 shows the sideways followed by a death cross, resulting in short-term downtrend. Number 2 shows golden cross, resulting in change of trend. Number 3 shows another death cross resulting to change in momentum, from uptrend to sideways. Number 4 shows the intertwining of MAs with the price, and indication of sideways. Number 5 did not show a golden cross, however, the price is above both MAs, an indication of uptrend. Number 6 shows a death cross after the price moved in sideways, indicating the beginning of the downtrend. Aside from double crossovers, a trader may also look for triple crossover to add more conviction about the presence of a primary trend. While a double crossover uses 2 MAs, a triple crossover uses 3 MAs. Common MA periods used in triple crossover are 20, 50 and 100. Some traders use longer periods like 50, 150 and 200, or combinations of short periods and long periods. The direction of the MAs may also tell the trend. A rising MA may indicate an uptrend. A flat MA may indicate sideways. An MA pointing down may indicate a downtrend. This is especially true for long period MAs. In this example, the MAs formed a triple crossover, but notice that the price is below the short period moving average. MAs during sideways are intertwined with the price. The price may oscillate within the MAs. Crossovers may give false signals, so be careful. And take note that the 100 MA is flat. In an uptrend, buy when the price dips on 50 MA and sell when the price breaks below the 50 MA. For trend following strategies, always wait for the alignment of MAs and price. Also, wait for the long period MA to point up. In this example, number 1 confirms an uptrend as there is a presence of triple crossover with the price above the MAs. The price then dips on MA 50, signaling a buy for position trade. In number 3, the position was sold when the price breaks below MA 50. Notice that the price still continued to go up after exiting the trade, but the momentum changed from uptrend to sideways. That's because a break of MA 50 may signal change in the price momentum. MA 200 is considered by many traders as a strong support, and the last stand for long-term uptrend. Therefore, when the price breaks below, it may signal the start of downtrend. Go short if this happens. Always look for the bigger picture. The price may move in sideways as signaled by the shorter period MAs, but the primary trend is still valid. Therefore, always put the price movement on context of the primary trend. Always wait for the correct entry points. Incorporate other indicators and technical analysis tools along with the MAs. In this chart, short period MAs signal sideways. MACD crossover signals change in momentum. MACD histogram is below 0. RSI shows bearish divergence. The trader may conclude that there is a change in momentum from uptrend to sideways, thus shifting the trading strategy or locking profits. And finally, remember that trading is not perfect, so always manage the risk by carefully planning ahead the trade. Always consider the portfolio allocation size. And also plan your stop loss before the trade. If you find this video helpful, don't forget to like and subscribe.